Okay, good afternoon, guys. Good afternoon. My name is Raul Rivera. I am the founder of themarketprofile.com. Today is Thursday, August 17th, 2017, and it seems like Thursdays, it's become a habit now. Every single Thursday, we've been selling off, and we had quite the sell off today, almost in the same magnitude of the one that we had last Thursday. So, second bloodbath in a week here, and it was quite the trend to the downside. And what's interesting, before we get started here looking at market profile charts, what's really interesting is the amount of premium going into out of the money August and September calls in the VIX. Okay, out of the money calls in September and August. As far as 22 and 23, I think they even tried to get 25 calls. I think the 25 calls are a little ridiculous, but the upside calls in September for the 20 strikes in the VIX are definitely a bit concerning, and also the put option activity in the SPX index, the increase in the put activity in the SPX cash index is also a little bit concerning. So a lot of protection going into the end of August and the beginning of September. Another thing to note is that Congress is coming back from vacation, and when they come back, they're going to deal with the same thing they deal every September, which is that debt ceiling, right? Every single September. So that's going to be a catalyst going into September. The fact that we're probably not going to get a rate hike is going to be a catalyst into September. So a little bit of volatility is coming back. And on the back end of all of that, we don't, there is no clarity as of yet as, whether these missile tests from North Korea are going to stop. So a lot of things are starting to bundle up together and cause a bit of volatility. And I believe this is the reason why a lot of hedge funds, especially the large traders, are, protecting their portfolios, buying upside calls in VIX and downside puts in the SPX. Now, with that said, today was definitely the roughest day all year, and I had to look back at my, my archives, and what I found is that the last time I had a day like today was back in July of 2016. July of 2016. I had a 20 lot trade in the NASDAQ that was a loser for about 20 points, and I took quite the hit on that day. And today, much of the same. So I actually took a 20 lot trade here in the S&P, adding as the market kept going down. But, this was something I discussed yesterday. 80% of all trading days are always going to be a range day, and then 20% are going to be trend. Today is a trend day. Okay? And it's hard to recognize these trend days until they actually happen, right? Very easy in hindsight, but in real life trading, you understand you're in a trend, but with an entire year of low volatility, it's really conditioned, not only myself, but a lot of other traders that I know, that it's really conditioned us to continue buying at the lows because at some point they're going to buy it back. That's not the case anymore. Now that we're seeing a lot of volatility and upside calls in the VIX, things are starting to change a little bit. The structure of the market, where we've had low volatility under 12, is changing. So today we had a trend day, obvious, and a pretty big losing day for me here. So if we split the distributions into portions, we got plenty to choose from. I mean, check this out. We have a D, followed by a B, followed by a B, followed by a B, followed by a B. I mean, 1, 2, 3, 4. I think there's a fifth leg in here. 5 legs to the downside. That's pretty concerning. Looking at the, whoops, I didn't mean to do that. X, right there. Looking at the institutional order flow, it wasn't as bad as last Thursday, but you can see we made a low just under negative 20,000, which is pretty large selling. That's a lot of contracts, right? So if I'm looking at contracts that trade or if I'm looking for trades that are higher than 50 contracts but less than 2,000 contracts, and I take the difference between the bid and the ask, I get a positive or negative number. Positive being that there are more buyers than sellers, and negative being that there's more sellers than buyers. So you're telling me that these guys, these large players, okay, are have an overabundance of sellers of 20,000 contracts. That's pretty big. So there's a lot of selling there. But last Thursday's sell-off was even bigger. Okay, when we take a look back here, here is last Thursday's sell-off, and we ended that day just under 30,000. So 10,000 contracts more of power to the downside we had last Thursday than we did this Thursday. Now, this is a classic, a very classic looking dead cat bounce. Here in the S&P, let me come over here. Very classic dead cat bounce. If you're not familiar with that term, it's just a Wall Street, term for pretty much a lower high followed by a lower low in pretty much quick succession. So we made a high up here, right? We traded lower, made a low, came back, couldn't take out that high, and we took out the low. So lower high, lower low. So now we're kind of in a defined trend. Okay, a downtrend is always made by lower highs and lower lows, and an uptrend is made by higher lows and higher highs. And here we have pretty plain and simple dead cat bounce in the S&P 500. I think we're definitely going to trade lower going into tomorrow, though the buy the dip buyers might try to rally it tomorrow, but because it's options expiration, I think we're just going to consolidate, right? Every Friday options expiration, and this is the third week of August, so August expiration is also going to happen tomorrow. It's not just the weekly options, it's also the August options. So with those expiring, I don't know if the market makers or anybody who's really trying to move the market is going to want to really push prices any higher or any lower. I think they're going to try to consolidate and then try again in the direction of the move, which is to the downside, coming up on Monday. So looking at the S&P, let me show you my fills. Pretty embarrassing, but you know what? I'll own it. I'm not afraid to show anybody when I have winning days, and I'm not afraid to show anybody when I have losing days. Okay, so let's switch it over to hybrid. And my first set of contracts came in here, 5 contracts between 54 and 52. I bought another 5 contracts between 48 and 46. I bought another 5 contracts at 39 and then 35. And as you can see, I took off the entire 20 lot position at 24.30. Okay, 24.30 flat. That was my absolute stop loss on the trade. It was about 12 or 13 points, 12 to 13 points on a 20 lot. Okay, you do the math. That's a bloodbath to say the least. So worst trading day in the S&P 500, worst trading day of 2017, and year to date, I'm up 123,000 minus today. Okay, that would be, let's pull it up. Can't do math in my head. 123 minus 15, so 108. So I pretty much lost quite a bit of a percentage here of my overall profit on the year. But at least I know that I could handle it in a sense, but it's upsetting to say the least. And looking at my performance spreadsheet, if I have a good month for the rest of the month and then a good month in September, I will have made up the deficit. But now it's an uphill battle, and it's going to be a tough one here to gain this back from the S&P 500. But with volatility, there's opportunity, and all I have to do is just readjust my trading to high volatility. I think that's part of the problem as well with the way I handle myself here in the S&P 500. Okay, taking a look at crude oil. This one, I took a small trade, and then with the S&P moving lower on me, I decided to cancel all pending orders on just so I don't add extra risk to my trading. So I took one contract here at 47.10. It did trade as low as 46.80 until it came back. I had another 4 contracts to be filled at 15 and then 20. And right there, I mean, definitely called the high of the day. Like I said, 80% we're always going to be ranging, and then the other 20% we're always going to be in a trend. And here in crude oil, you know, the 80% fell in the favor here, so we were able to call the high of the day with very good success here in the 30-year, in the crude oil market. But you know, with things going a little bit crazy, I decided to cancel these orders and then take off the position and just focus on the S&P. 47.04, that was the profit there, so 6 ticks on one contract, it's only $60. So it was a tough day today. Gold, okay, this one, and this is where the market profile shines, because I know exactly where I want to get long, I know exactly where I want to get short. And I know, and I have that information well in advance. Okay, I have that information well in advance. Okay, so here, I caught the absolute low of the day perfectly in gold. 12, we can see my fills here, 1287.80, 1288, and then 1287.30. One of these I got slipped on, okay, because I think 87, I had 2 contracts at 80, so I got slipped on this one here, which is positive, right? It's a positive slippage, because I had 2 contracts at 88, but I'm only seeing 1 contract filled at 88, the other one at 87.80, 2 ticks under this my original entry location. So positive slippage there. I got filled at a price that is better than what I was trying to get filled at, and that happens when the markets move very, very quickly. And then I added a second contract here at 87.30, and I had another 2 contracts to get long at 86, so we came very, very, very close, 87.30 to get a final to get a fill in. I think actually 87.5, that was where I was trying to get long, not 86, 87.5. And so you can see 87.30 was the spot, but guess what? The market did touch 87.5. And here is an interesting example of slippage. In this case, I did not get filled. So we're going to go ahead and we're going to zoom in and we're going to take a look at the footprint on the gold contract. Now I'm going to go ahead and expand it just to get the numbers a bit bigger. I'm going to go ahead and scroll down, keep going down, and we'll stop right there. Okay, and here's the interesting part. If we take a look very, very closely right there, we see 3 separate zeros. So 0, 0, and 0. We even see a 0 right there. What does that mean? It means that prices at those levels move so quickly, and whoever was trying to get long at those levels or short at those levels, or providing liquidity at those levels, they pulled the liquidity away, right? They pulled it away, and when that happens, you go through what's called slippage. Now, slippage usually occurs when there's a big announcement due. Like if, for example, we take a look at the FOMC minutes yesterday, and we check out the reaction of the gold market or the bonds. The reaction to something like the FOMC or the non-farm payrolls is big, right? It becomes an illiquid condition for about a few seconds before the market comes back to its senses and liquidity is provided. But that lack of liquidity is called slippage. And because there's no liquidity, it means you can't get in or get out of the position as easily as you'd like, because no one is interested in what you're buying or selling. Okay, nobody is interested in providing the other side of the transaction for you. So I had an order here 66, 86.50, and I wasn't filled. Okay, and when I'm looking to buy, I'm on the ask side. So on the right side of this candle is the ask side, and we can see every single order that was executed on the ask side during this time period, and on the left side we have the bid. So if I'm looking to buy, I have to buy the ask, and if I'm looking to sell, I have to sell the bid. I cannot buy the bid. Okay, I know there's buttons on NinjaTrader that say buy the bid, but that's not real. What it's saying is you're going to put a limit order where the bid is, and when the market comes down and is asking for that price, you're going to get filled. Okay, so it doesn't work in that way. There's always going to be a diagonal relationship between the bid and the ask. It's never going to be it's always going to be the ask above the bid, never the bid above the ask. It's always going to be like this. This is the relationship. It's never ever going to be this way, the bid above the ask. So in this case, I had 5 contracts. I didn't get filled on 2 because I got slipped. And I took profits all the way up here at 90.73 points. Good for $900 profit here on this gold trade. I promised myself I wouldn't trade the 30-year, and my gut was correct on this one. It was a pretty decent opportunity early. Okay, as you can see, the market did trade much higher above. But early, we did trade into this sell zone. We were looking to sell 03 to 08. Market traded a little higher above that, but then came all the way down to 54.28. So, provided a pretty decent trade, but it didn't last long. As you can see, the market then popped. This week I haven't been so efficient in trading the 30-year. I think on Monday or Tuesday I had to break even on a trade, and then yesterday I had to take a loser just before the FOMC. And for those reasons, I just did not want to trade the 30-year bond this week. It just seemed like it's not going in my favor, so why am I going to keep trying? So the 30-year here, found this level, respected it for a very short period of time, and then blasted off to the upside. So 2 markets that respected the market profile today. 2.5 markets. So this one would be the half, right? Gold, and then crude oil, and that's about it. The rest of the markets were just horrible. Looking at the NASDAQ here, big dip lower again. We were able to successfully call at least the low of the day, or the low of a specific period. That's it, because we continue to trend lower, and we're actually still trending lower. The S&P is at 24.26 half. That's crazy. So we had a D, started falling with a B and a B. If I split the distributions here, we can see that, and this is one of the great features of our software, is we can split these distributions and merge them just like that, with a simple click of the mouse. And what it does is it pretty much shows us the distribution shapes without us having to guess. So D shape, B shape, much like the S&P, B shape, B shape, B shape. What's interesting is that the levels that we were looking to buy here in the NASDAQ are the same levels where we distributed, right? So we had distribution at this level, which means there was a bit of consolidation there, right? Prices did react to these levels, and that's all we asked for out of the market profile. The market profile is a charting technique to discover where value lies in the market, and we couldn't have been any better with this. Look right here again, consolidation, and I don't just draw up these numbers and these ranges and say here you should buy, here you should sell. Okay, I'm not doing that. I base these numbers on the market profile. Okay, we look for value. Number one, we split distributions to find where value is in the market, and then number two, we buy and sell at those areas. And that's exactly what we do here, trading the market profile. As you can see, the S&P is taking out the lows, the Dow is taking out the lows, but here in the Nasdaq, we still have quite a ways. 57, 70, and 60, those are the lows in the Nasdaq. So surprisingly enough, tech stocks are holding up slightly and not forcing the Nasdaq to really just crash here. No trades were taken here in the Nasdaq today by me, so I don't have much to talk about there. And then here in the Dow, unfortunately, another losing trade, which took my losses just another elevated level. Trying to do the exact same thing here with the Dow as I did with the S&P. Let's switch over to the profile view. As you can see, I mean, same exact thing. I mean, the Dow, the S&P, and the Nasdaq, they're all derivatives of each other, right? So they're all gonna have the exact same. If one market is ticking higher, the other two are ticking higher. If one market is ticking lower, the other two are ticking lower, right? So I mean, they're derivatives of each other, and whatever. So same thing. But again, look at where value was created in the past and where it was created today. So we can see distribution here, smaller distribution here. So when prices enter these areas, and I'll show you here on the hybrid view, there was a reaction in the market. Here we entered, consolidated sideways, right? Here we entered, consolidated sideways for a bit, and just underneath that zone too, until we created this just sell-off right afterwards. So here, this trade losing about 100 points on 6 contracts. And like I said, I'm not ashamed. I will show it. I'm man enough to show my losers as much as I am at showing my winners. And here in the Dow, I started buying around 90, around 25, 21, 925, 15, and then 05. Added another 3 between 850 and 830, and then I closed my position here at 78, just a little bit less than 100 points, just a little bit over 100 points. So 100 points in the Dow is equivalent to 10 points in the S&P 500. So don't think, oh my God, 100 points is a lot. The leverage is different. So 10 points in the S&P is the exact same thing as 100 points in the Dow. The exact same thing. Still, not something to be proud of, but something to keep in mind that 100 points in a market that's 22,000 is it's valued at 22,000. It's not really that much, not even close to 1%. 200 points, that would be a little close to 2%, right? 22,000. So that was the Dow, and then if we move back here, hang on, so I have the chart, and then let me, because you guys won't be able to see this. Whoa. Okay, LB. No, RB. There we go. One successful trade I had for at least break even was here in the euro, and in the euro we had a trend day to the downside. As we can see, the market did trade lower here. Let's switch over to profile view. And we found value in this area here. We highlighted it pink because it wasn't outside the range of today's market, but we were trading all the way down here at that point. So it was probably well worth a shot to try and short on a market that's moving lower. We also had a VWAP and TWAP in those areas with near proximity. So we were definitely looking to be short there, and the idea worked out. You just had to wait a long time for it. So we had a D followed by a B, find a place to sell it. we found value in this area, and of course up here, but market did not trade all the way up to the 118 area. Today it just continued to trade lower, and so let me show you my fills here. This one I did break even on it. I think I might have lost one tick on this trade, and here we can see I sold one contract at excuse me, two contracts at 1742, right after the decimal point, 1742, and I added two more contracts at 1769, which was right at the TWAP. And if we switch over to hybrid view, we'll be able to see that it's this tan line. You know, it kind of, in contrast, it doesn't look too good here with the pink, but it's right there and added right there at 69. That also happened to be the high of this distribution, and I did take off my position over here for about break even on this bar. So you can see if I'd have held it a little longer, I probably would have made an extra 10 ticks on the trade, but I closed it. I said, you know what, I have break even on at least one trade, I'll take it right away. But the idea, again, one and the same. Finding areas of value and placing orders at those areas, you're always going to get a reaction of price, and it's always going to be in the form of support and resistance. Always going to be in the form of support and resistance. And then here in the yen, like I said, you know, just to minimize my risk because I had way too much on the S&P and the Dow. Here in the yen, couldn't have done it any better, calling the absolute high. We tried to catch a low down here. We were trying to buy 90,500, between 90,600 and 90,500, and then trying to sell 91,400 to 91,500, and successfully, by locating value on a non-trending market, because today it seems like all the indices were definitely trending, but of course some markets were not. Not every market is going to trend if the S&P 500 is trending, right? So here, I mean, successfully calling the high. Of course, prices are trading at that level, but we did reach this area, and we did trade lower from it. Not too far low, but we did trade low from it. These currency markets open at 8:20 in the morning Eastern time, and they close at 3. They don't necessarily close, but they settle at 3 p.m. And anything after that is very low volume, very slow type of trading. So, you know, by 3 o'clock, I'm like, you know what, let me get out of the position here in the euro, but it did trade lower. And here in the yen, as you can see, things just slowed down by a whole lot. But anyways, guys, tough day. All we can do is just hold our heads up high and look forward, not backwards. So if you guys like this video, make sure you guys click like on the video, and if you guys have any questions about my trading or my style of trading using the market profile, please feel free to comment, or check me out live real time, www.themarketprofile.com, where you can see me trade every one of these markets that I showed today, plus other markets that I have tucked away that, you know, I might not necessarily trade, but markets that you might necessarily trade. Something like the Russell, the British pound, maybe even natural gas. So definitely come check it out. Claim your 14-day free trial of the live trading room. And I hope to see you guys in the room. If not, then good luck with your trading. And I will be back tomorrow afternoon to have another great video like this one. Thank you guys for watching, and I hope you all have a great evening. Thanks, guys.